The global financial market is projected to reach a staggering value of £26.5 trillion by 2025, highlighting the immense scale and significance of this sector in the worldwide economy. Within the United Kingdom, financial services make a substantial contribution of 7% to the nation's GDP, underscoring its vital role in the country's economic framework. Banking serves as a major employer in the UK, providing livelihoods for over 1.1 million people across various specializations and roles. The sector's reach is remarkably extensive, with 95% of UK adults holding at least one banking product, demonstrating its pervasive influence in everyday financial management and planning. Banking traces its origins to ancient Mesopotamia and Rome, where temples safeguarded valuables and merchants extended credit for trade. The 18th and 19th centuries saw the rise of commercial banks, central banking systems, and standardized financial instruments supporting industrialization. From physical branches to digital platforms, banking has evolved into a sophisticated ecosystem with deep interconnections to economic activity and societal well-being. This presentation explores the fundamental concepts of banking and finance, beginning with the core principles of financial intermediation and monetary systems. We examine market structures, regulatory frameworks, and emerging trends shaping the future of financial services in an increasingly digitalized world. Financial intermediation addresses the fundamental economic challenge of connecting those with surplus capital to those requiring funding. This process occurs through direct financing channels, such as banks and other intermediaries. Surplus units, financial institutions, and deficit units play crucial roles in this system. The existence of financial institutions is largely justified by their ability to reduce information asymmetry and transaction costs. These institutions perform crucial transformation functions, converting short-term deposits into long-term loans, diversifying risk, and providing liquidity to the economy. At its core, financial intermediation connects surplus and deficit units within the economy. Banks act as specialized firms that profit from the spread between lending and borrowing rates, whilst providing valuable services to both sides of the transaction. The process creates economic value through more efficient resource allocation, expert risk management, and the provision of payment systems that facilitate economic activity. By transforming risks, banks enable transactions that might otherwise not occur due to information or scale constraints. Money has evolved from commodity-based systems to fiat currencies backed solely by government decree, and now to digital forms including cryptocurrencies. Each innovation has expanded money's utility whilst raising new challenges for monetary authorities. Money serves as a medium of exchange, facilitating transactions by eliminating the double coincidence of wants required in barter systems. It also functions as a unit of account, providing a common measure for valuing goods and services, enabling economic calculation. As a store of value, money preserves purchasing power over time, allowing wealth accumulation and future consumption. Transaction cost theory explains money's emergence as a solution to the inefficiencies of barter systems. In barter economies, each transaction requires a double coincidence of wants. Each party must desire what the other offers at the same time and place, creating significant coordination problems. Money addresses information asymmetry by providing a standardized unit for value comparison and exchange. Its adoption follows network effects, where each agent a particular form of money. The more it is embraced as a medium of exchange, creating self-reinforcing adoption patterns that explain monetary system stability. Modern monetary theory employs sophisticated exchange models to explain how money functions within economies. Social trust networks, institutional and cultural frameworks support monetary systems. Money acts as a memory device, recording economic contributions and obligations. Search and matching theory reduces transaction costs through standardization. This perspective illuminates how monetary systems function as social exchange patterns, significantly increasing economic efficiency. The concept of money as a memory device suggests that currency serves as a record-keeping technology, tracking economic contributions and obligations. This perspective illuminates how monetary systems function as social exchange patterns, requiring institutional foundations and collective acceptance to maintain their value and utility in facilitating economic activity. The demand for money reflects individuals' and businesses' desire to hold liquid assets for various purposes. Money is needed for everyday purchases and payments, closely linked to income levels and payment technologies. Influenced by payment frequency, transaction costs associated with converting between money and other assets. Precautionary demand buffers held for unexpected expenses or opportunities, varying with economic uncertainty and access to credit. Baumol-Tobin model provides a mathematical framework balancing the opportunity cost of holding non-interest-bearing money against transaction costs of converting between assets. Predicts that money holdings increase with transaction volumes and costs, but decrease with higher interest rates. The portfolio approach to monetary demand uses cash holdings as part of broader asset allocation decisions. In this framework, individuals and institutions balance liquidity against potential returns from other investments, with money serving as the most liquid option, typically yielding varied uses. Empirical research on money demand reveals strong income and interest elasticities across economies. Monetary demand stability. The consistency of relationships between money holdings and economic variables has become increasingly challenging as financial intermediation continuously creates new money substitutes and payment methods. These evolving patterns complicate central banks' response as policy targets or indicators, contributing to shifts toward interest rate-focused monetary frameworks in many economies. The structure of banking institutions varies significantly across markets, reflecting different regulatory traditions, market demands, and historical developments. In some jurisdictions, universal banking models predominate, whilst others maintain stricter separation between different types of financial activities. Retail banks focus on consumer and small business services, offering branch networks, digital banking platforms, and personal financial products. Commercial banks specialize in business lending and services, providing credit facilities, cash management services, and trade finance solutions. Investment banks engage in capital markets and advisory services, including securities underwriting, mergers and acquisitions, and trading activities. Modern banking operations extend well beyond traditional intermediation to encompass a complex ecosystem of financial services. Off-balance sheet activities, such as commitments and derivatives, provide a crucial avenue for banks to enhance returns whilst managing regulatory capital requirements. Core banking services form the backbone of commercial banking, profiting from the net interest margin, the difference between interest earned on loans and paid on deposits, whilst managing credit, liquidity, and interest rate risks. Fee-based services generate substantial revenue from account fees, payment processing, wealth management, and other areas, diversifying income streams. Treasury operations involve trading their own funding and investment positions through treasury functions, participating in interest rate hedging and access to short-term liquidity markets, and optimizing the overall balance sheet structure. Banking performance analysis requires specialized metrics that focus on the unique nature of financial intermediation. Profitability measures like ROA and ROE provide insights into returns, whilst NEM focuses specifically on the core lending deposit spread that traditionally drives banking economics. Efficiency ratios highlight how effectively banks convert inputs into value, with the cost-to-income ratio serving as a key benchmark for operational performance. Risk-adjusted measures like RAROC and economic value added, EVA, have gained prominence as banks and regulators increasingly focus on returns relative to risks assumed rather than absolute profit figures. Financial markets serve as the infrastructure connecting capital providers with users, facilitating price discovery, risk transfer, and liquidity provision. Their efficiency determines the resources effectively utilized, enabling innovation through the economy, making instruments design and regulation critical economic policy concerns. Primary markets are where new securities are issued and sold directly to investors, channeling fresh capital to governments and corporations. Secondary markets provide liquidity, allowing investors to adjust positions without issuing new securities. They include stock exchanges, bond markets, and over-the-counter networks. Derivatives markets facilitate risk transfer and price discovery through futures, options, swaps, and other instruments that enable hedging, speculation, and arbitrage activities. Equity markets provide avenues to raise capital and for investors to participate in corporate ownership and growth. Modern stock markets have evolved from physical trading floors to predominantly electronic systems, where exchanges execute millions of trades per second. Price formation occurs through the continuous matching of buy and sell orders with market microstructure, the detailed rules and mechanisms governing trading, significantly influencing transaction costs, liquidity, and price efficiency. Stock indices like the FTSE 100 aggregate individual security prices to provide benchmarks for market performance and serve as the basis for numerous investment products. The efficient market hypothesis, EMH, posits that financial markets rapidly incorporate available information into prices, making it difficult or impossible to consistently outperform the market. This theory has profound implications for investing strategies, suggesting passive index approaches may be appropriate for many investors. Numerous market anomalies, such as the size effect, value premium, and momentum patterns, challenge strict interpretations of market efficiency. Behavioral finance explains these anomalies through psychological biases and institutional constraints that affect investor perception and rational decision-making. Investors face a complex relationship between risk and return across asset classes, with higher investments generating greater returns as compensation for the volatility. Risk metrics like value at risk, VAR, and expected shortfall help quantify potential losses under adverse scenarios, providing investors with tools to align portfolio risk with their tolerance and expectations. Systematic risk affects all securities within a market and cannot be eliminated through diversification, whereas idiosyncratic risk is specific to individual securities or assets and can be reduced through portfolio construction. Modern portfolio theory revolutionized investment management by formalizing the relationship between risk and return at the portfolio level. The key insight, that asset combinations can produce better outcomes than individual securities in isolation, underpins contemporary approaches to wealth management and institutional investing. Diversification benefits arise from imperfect correlations, allowing investors to reduce portfolio volatility without necessarily sacrificing returns, creating more efficient risk-return outcomes. Markowitz's model quantifies the trade-off between expected returns and risk, enabling mathematical optimization to identify portfolios that yield the highest return for a given level of risk. The curved line representing optimal portfolios dominates all other combinations, with investors selecting along this frontier based on their risk preferences. Equity trading has undergone radical transformation with the rise of electronic execution, high-frequency trading, and alternative trading systems. Market fragmentation across multiple venues creates both challenges and opportunities for traders seeking best execution in an increasingly complex ecosystem. Modern equity markets operate primarily through continuous auction systems where limit orders accumulate in an electronic order book until matched. Alternative mechanisms include dark pools where intermediaries provide liquidity by quoting buy and sell prices, and periodic auctions that batch orders for execution at specific times. Beyond simple market and limit orders, traders employ sophisticated order types to enhance execution. Implementation shortfall strategies aim to minimize deviation from decision prices, whilst VWAP strategies aim to match volume-weighted average prices over specified periods. Despite its theoretical elegance and intuitive appeal, CAPM faces considerable empirical challenges. Nevertheless, its framework remains influential in portfolio construction, performance evaluation, and corporate finance applications, particularly for cost of capital estimation. The capital asset pricing model establishes a linear relationship between expected returns and systematic risk, measured by beta. This concept suggests that investors are rewarded for bearing market risk, not for diversifiable risks specific to individual securities. Empirical tests reveal significant deviations from CAPM predictions, with size, value, momentum, and other factors explaining return patterns that beta cannot address. These shortcomings have spawned more advanced models like the Farmer-French three-factor model, which incorporate additional risk factors beyond market beta. Global equity markets comprise a network of exchanges and trading platforms where company shares are bought and sold. The primary market facilitates capital formation through initial public offerings and secondary issuances, whilst secondary markets provide liquidity and price discovery for existing securities. The UK equity market, centred around the London Stock Exchange, features both the main market for established companies and AIM for smaller growth firms. With its strong regulatory framework and international orientation, London remains a premier global financial centre despite Brexit-related challenges and increasing competition from Asian markets. Trading mechanisms have evolved from open outcry to sophisticated electronic systems that match orders in milliseconds. Market structure continues to evolve in response to regulatory changes like MiFID II reshaping execution practices and transparency requirements across European markets. Fixed income markets encompass a vast array of debt securities issued by governments, corporations, and other entities. Bond pricing reflects the present value of future cash flows, with prices moving inversely to yields as interest rates fluctuate. Yield and measures include yield curve analysis, credit spread analysis, and positioning different exposures on bond durations. The term structure of interest rates, yield curve, reveals market expectations around monetary policy. Credit spreads help in risk assessment, where premium over comparable government securities reflects issue-specific risks and macroeconomic conditions. The UK gilt market serves as a cornerstone of domestic financial markets, with issuance supporting banks, state-owned firms, and government spending. The Debt Management Office manages issuance across various maturities to meet funding needs while maintaining market liquidity. Derivatives markets serve crucial economic functions beyond their sometimes controversial reputation. They enable risk transfer from those seeking to reduce exposure to those willing to assume it at lower transaction costs than in comparable securities. Their price discovery function provides valuable forward-looking information about market expectations. Futures contracts are standardized agreements to buy or sell assets at predetermined future dates and prices. Options grant the right but not obligation to buy or sell assets, offering sophisticated risk management strategies. Swaps allow parties to exchange cash flows, and structured products combine traditional securities to create customized risk-return profiles. The foreign exchange market is the largest and most liquid financial market globally, with daily turnover exceeding $6.6 trillion. Unlike centralized exchanges, FX trading occurs primarily through electronic networks connecting dealers worldwide, operating continuously across major financial centers to accommodate global trading hours. Exchange rate determination involves complex interactions of interest rate differentials, inflation expectations, and geopolitical factors. Various models, from purchasing power parity to asset approach, incorporate capital mobility, attempt to explain currency movements, though short-term exchanges offer limited consistency with theoretical fundamentals. Currency management represents a cultural function for international businesses and investors, employing forwards, futures, options, and swaps to hedge against adverse cross-border activities. Central banks serve as the cornerstone institutions of modern monetary systems, controlling the money supply, influencing interest rates, and safeguarding financial stability. Their structure reflects changing economic understanding and the challenges of maintaining stability in increasingly complex financial systems. The Bank of England's primary objective is defined as 2% CPI inflation, while supporting the government's economic policies, including growth and employment goals. Monetary policy affects the economy through multiple channels. The interest rate channel influences borrowing costs and investment decisions. The exchange rate channel affects trade competitiveness. The credit channel operates through asset price effects on consumption and investment. The central bank wields power through bank lending capacity and risk perception. The central bank has evolved from primitive lender of last resort functions to unconventional measures like quantitative easing and forward guidance in response to financial crises and secular economic changes. Central banks influence the money supply primarily by controlling the monetary base, currency in circulation plus bank reserves at the central bank. This high-powered money forms the foundation for broader monetary control through a fractional reserve mechanism, where deposits can be partially lent out, creating new deposits elsewhere in the system. Traditional monetary control relied heavily on reserve requirements that limited banks' lending capacity relative to their deposits. However, modern central banks have shifted toward using interest rate targeting and open market operations as more effective tools. The discount window, lending and deposit facilities, allows banks to borrow directly from the central bank, providing a way to manage or control interest rates while ensuring liquidity for temporarily illiquid institutions. Financial innovation continually creates new instruments and payment methods that blur the boundaries between monetary aggregates, complicating central banks' ability to control the money supply. Money market funds, payment apps, and other liquid instruments that function like traditional deposits have created highly liquid assets that function as money without full parity to traditional monetary measures. These innovations contribute to velocity instability, changes in how quickly money circulates through the economy, making simple monetary aggregates less reliable indicators of economic activity. This potential may prompt central banks to de-emphasize monetary targeting in favor of other measures. The rise of digital currencies presents new challenges for monetary control, potentially creating parallel systems that operate outside traditional oversight. In response, many monetary authorities are exploring central bank digital currencies, CBDCs, to maintain relevance in an increasingly digital financial landscape. The historical shift from monetary targeting to interest rate frameworks reflects both theoretical developments and practical experience. Monetarist approaches aim to control the quantity of money amidst financial instability, but difficulties in controlling aggregates precisely enough to achieve targets arose. Interest rate targeting proved more effective in communicating policy stance, influencing market expectations, and responding to the diverse economic conditions. This approach aligns with modern central banks' interest rate transmission mechanisms, whilst still allowing monetary aggregates to serve as indicators where appropriate. Hybrid approaches combine elements of both strategies, offering flexibility in response to economic realities. The European Central Bank notably maintained a prominent role for monetary aggregates until recently, reflecting Germanic monetary traditions. Central bank credibility, the market's belief that monetary authorities will follow through on their stated policies, substantially impacts policy effectiveness. The time inconsistency problem identified by Keidland and Prescott reveals the temptation for policymakers to deviate from announced plans once private sector expectations are set, leading to inflation bias in discretionary regimes. Reputation mechanisms help overcome this problem by making the long-term costs of policy reversals exceed short-term benefits. Transparent communication strategies, including forward guidance about future policy paths, detailed meeting minutes, and increased central bank independence with democratic accountability, are essential to enhance policy transmission and to strengthen central bank independence within democratic legitimacy constraints. The political economy of monetary policy explores how institutional arrangements affect policy outcomes beyond purely economic considerations. Recent monetary theory suggests independent central banks achieve lower inflation without sacrificing growth, though causality debates persist regarding whether independence itself improves outcomes or whether other factors associated with good governance reflect deeper institutional strengths. Independence must balance with democratic principles through robust accountability mechanisms. These typically include legislative oversight, transparent decision-making requiring public reporting, and appointment procedures involving elected officials. The Bank of England's framework includes Treasury oversight powers to arbitrate tensions and parliamentary testimony requirements. Empirical evidence consistently supports the credit channel's importance during financial stress periods. Studies show amplified policy effects across different financial systems, with significant variations in impact across different financial system structures. This transmission mechanism operates through the impact of monetary policy on bank reserves and deposit creation. When central banks tighten policy, bank reserves decline, potentially constraining lending capacity if banks cannot easily substitute other funding sources. This financial accelerator mechanism amplifies economic fluctuations by affecting borrowers' financial positions. Policy decisions reduce collateral values and exacerbate creditworthiness, particularly affecting smaller firms and households with limited access to capital markets. During monetary contractions, lenders typically become more risk-averse, shifting credit allocation towards safer and higher-rated borrowers. This relocation can disproportionately affect smaller and riskier borrowers, and during certain economic conditions, the flight to quality preference becomes a binding constraint on lending.